Welcome to Nestology. We are your hosts. I'm Jessica.
And I'm Shelley.
And today, Shelley's going to share with us some tips on credit scores.
Fun. Let's talk about credit, because that's key to everything in life, pretty much.
Unfortunately, yes.
It really is. It impacts more than you think.
Yeah. Well, too often we see people who they're spinning their wheels. I see it where I tell them get pre-approved, pre-qualified, and they're like, well, our credit score's low. We're going to work on this. And then they don't have a game plan. They don't know. So then they're spinning their wheels, paying off something that isn't as important, or missing a payment somewhere because they've focused their priorities on the wrong area. So you're going to tell us how people can improve their credit score and what things are going to hurt the most. People are struggling right now. So if something is
it's bad out there.
If you have to miss a payment somewhere, what are you missing a payment on?
My goodness. Yes. Okay.
So, I hate that we have to go there, but it's reality for some people right now. So what are the common misconceptions around credit score?
Oh my goodness, there's quite a bit.
Okay.
But what I would really start with is, I know this sounds very, very simple, but make your payments on time.
Yeah.
That's kind of a big one. And then if you are actually in a situation where you have to make a decision to pay, I don't know, let's say a credit card versus a mortgage on time, always pay the mortgage on time.
Yeah.
A
or
credit
rent
card or rent. Yes. Your living situation, pay those bills first. And the reason why I say that is because, if you're 30 days late on a credit card, that's not necessarily just one event that's going to prevent you from getting a mortgage or something along those lines. But if you miss a mortgage payment, the mortgage company, what we're really looking at, we look at, have you made the last 12 months on time? So that's a situation to where one missed payment or late payment could totally mess up you buying a new home or even a refinance for that matter.
Yeah.
Right?
Well, you were just talking about that.
I know. I'm so sad. I just, I have some sweet clients, past clients of mine that are wanting to do a refinance. And when you do a VA, a veteran refinance, right, the only thing really we need in that situation is 6 months of on-time payments. And these sweet clients, were just getting them going and found out they made their December mortgage payment on January 2nd.
Oh, no.
So now we can't even do the refinance.
Yeah.
We have to wait 6 months. We have to have 6 months. So starting with January, so we're not going to be able to do it until July.
That's sad.
I know. It's so sad. But that is something that we typically are going to be looking at the most stringent, right? So then you would talk about say, student loans would kind of be next. Any kind of federal debt is something that you want to really focus on. Those are important.
Yeah.
We look at those differently as well. Yes, all bills, we want them paid on time, right?
Yeah. But some do get weighted differently. And I see it with people renting. That's why I threw that out.
Yes.
Because there's people who will apply for a house to rent, and the landlord will be freaked out if they see your rent is not paid on time. If you're not paying your credit card bills on time, but you're always on time with rent, that holds so much more to them, because they know the whole thing is you want to get paid. You as the mortgage lender want to get paid. The landlord wants to get paid. So they want to see that those areas are priority for you.
Absolutely. And so let me just kind of dive in a little bit more in detail about when is it actually late on your credit report.
Okay.
Because, so you've got really 30 days to pay your mortgage, right? But you've got from the 1st to the 15th with no late penalty.
Okay.
Okay.
That's why I always thought it was late after the 15th. Well, like you said, because the late fees.
Right. So it is, you do get assessed a late penalty from the 16th to the end of the month, right? But that doesn't count as late on your credit report, right?
Okay.
What's late is after 30 days, or I guess if there's 31 days officially, it'd be 31 days, right? But if you pay your current month's mortgage payment the next month, whether it's the 1st or, after that, it's late on your credit. That's where it matters. So let's say you consistently pay it on the 16th of every month. That's actually okay. You're paying a penalty. If you paid it the day sooner, you wouldn't be paying 4% of your monthly payment in a penalty. Nobody wants that. But
it's not impacting you credit-wise.
Correct.
That's good to know.
Exactly. So there's the distinction there. So really best practice is to pay it, from the 1st to the 15th.
Because who wants to spend money on fees?
Well, I know. And I actually had a situation to where this is another weird mortgage thing, but when we are looking at certain types of loans, we're looking at how many months do they recoup the monthly savings, and that matters in how if we can do the loan or not.
Okay.
And so I had a client that had so many late penalties assessed that was added to the payoff amount of the loan that it kicked them out of qualifying.
Oh, no.
Simply because of the penalties were added, right? Because it was a high balance, and so 4% of that payment was a substantial amount, and you don't think about stuff like that.
Yeah.
So even that could kick you out of qualifying,
Oh, no.
for a refinance, because, if rates have been high, right? We know that. We've talked about that for the past few years, and they're starting to come down. So now people are starting to refinance out of those, 7% and higher interest rates.
Yeah.
And you don't want something like that to stop you from saving money,
Yes.
right?
Right. Well, and so what are some things if somebody's trying to bring their credit score up? They want to buy a house next year, and so they want to work on it. What are some of the things that they need to focus on?
So a lot of things that I see that would be driving credit scores lower would be, if you are close to the limit on a credit card, for example. So the general rule of thumb is if you can keep the balances of, credit cards to 50% or lower,
Okay.
you're going to get the best out of the scoring model for the credit scores if you keep the balance at 1/3.
1/3. Okay.
Okay. It doesn't have to be paid off. And that's
Yeah.
where people start thinking like, oh, I do like Dave Ramsey. I like, some of his concepts. I do not agree with paying cash for a mortgage because most people can't.
Yes.
So you do have to have credit to get a mortgage.
Yeah.
So, but I like his idea, the snowball effect and that kind of stuff, but that doesn't always work on as far as improving a credit score.
Right.
Because he's talking about paying one completely off and then going to the next one and paying it completely off. And that doesn't give you the best credit score.
Right.
You don't have to pay them off completely. Just get them down to 1/3 and you're going to get a better credit score overall.
Gotcha. So yeah, if you have a $9,000 limit, 4,500 is where you that's a good place to be, but even better if it's under 3,000. So you're at the 3rd.
Exactly.
Okay.
And so I see a lot of credit scores that significantly drop when you're just close to the limit.
Yeah.
It has nothing to do with being late or anything like that. It's just your credit
How much you're
usage.
using.
Correct. So another thing people too, I think, tend to want to they want to pay off a card and then they're like, I'm going to close that account.
Yeah.
Yeah, that doesn't really help your credit score either, because the credit scoring model looks at how much available credit are you utilizing.
Okay.
So the more that you have available that you're not using actually improves your credit score.
Right.
So I'm typically saying, no, don't close the account. And you might have a zero balance on an account for 10 years, but the creditor could close it for you if you don't utilize it. But
does it help? So I've heard this, so tell me if this is wrong, but to use it a little bit, like even if it's just $50 for a tank of gas and then pay it off, does that do more than leaving it empty all the time?
It actually does.
Okay.
Yes. And the other thing too that I would recommend that helps speed up a credit score improvement faster is, for example, if you get paid every 2 weeks, use it, pay it off, use it, pay it off, or pay it down, whatever the case may be. But if you are making basically double the payments, then that really helps too.
Gotcha.
Because you really never have a payment due, if that makes sense, right? You're paying it every 2 weeks.
And if you're a spender, it kind of helps to take some of that paycheck before you spend it on some new shoes and put it towards the credit card. So
exactly.
Because that's where the Dave Ramsey, like my husband does not follow any of that because he's always looking at where the money could be. So interest rates. And so he has that brain for it. And he's like, well, I'm fine having interest here because I can invest it and make more here. But I know some people, we've had clients like this where if they have cash in their hand, they will spend it.
It's gone.
If it's in their bank account, they will go buy anything and everything. So they really can't. Some people can't trust themselves with credit cards.
Oh, I know.
Like Shopaholic. What's that?
Oh, I know.
Confessions of a Shopaholic.
Confessions of a Shopaholic. Yeah. Great movie. And in the end, she pulls it out and she sells all of her stuff. So what else I was going to also talk about. So what we have also seen a lot of is, when you go in and say you make a purchase and then you get offered, oh, do you want to put this into 4 monthly payments?
Okay.
So this is kind of I'm going to call it a little bit of an issue or a problem on our end because we don't see those on a credit report necessarily.
Okay.
So all the, Affirm, Klarna, all of that. So I one time had a client who, they did that on everything. And we found out there was like 30 different, pay over time accounts. And we don't see those until we see the bank account because it doesn't show up on the credit report.
Right.
And so then, when it's over a certain amount, we have to use a minimum payment for those. If they're paying them over 6 months and things like that, if it's like, it's just ridiculous. And then trying to get a statement to show what they owe from Klarna is really challenging.
Yeah.
It's been an issue. So,
well, let me ask you this. So I see that sometimes, and usually it has the little logo next to it. So like I'll be checking out and it'll say make 3 payments and it'll have like a firm next to it, the little logo. But I've seen it on my credit card accounts that it will say like, I purchased plane tickets the other day. And when I went to go pay it, it says pay over time is an option here.
Yeah.
Is that through one of those or is it different if it's through your bank?
No, it's all the same.
Okay. Because it didn't have anything next to it. So it didn't have like the name brand.
I've seen that too. When I, put it on the credit card and then it'll say, you could split this into 4 months, just say no. I understand sometimes you may have to do that, but those things can also, impact your debt to income ratio.
Yeah.
Because if you're making a monthly payment, we have to count it. And it doesn't necessarily show up when we pull credit.
Yeah.
So it's kind of like, oh, surprise, we have more debt and we have to account for that.
Right.
Yeah. So try not to do that.
Yeah.
I know it can be convenient and, I understand times are tough for everybody right now.
Yep. Well, and I played around with it and it honestly wasn't a huge savings because I didn't go too far into it. I clicked to the next step to see what it would be. And it broke down, over like 4 payments or something. But then it was like a $30 fee per month for that. And when I calculated with the interest rate, even though interest rates are like 25, 30% right now, it wasn't that much of a difference. So it's not really a huge savings if there's a fee attached. Some of them I know do it for free, but they may have a promotion or something, but that one did not make much sense. So
I know.
So be careful, do your math.
So yeah, be careful of that. So that's something that we see, kind of on, the inside mortgage scoop of things.
Yeah.
That kind of pops up every once in a while.
Well, you got to be careful with it too, because too much of that where you're deferring, I mean, it sounds great to defer it, but that's just future self
You're going to pay more for it anyway.
Well, you're going to pay more for it and you're just postponing it. So future you will not love that when you have all these payments that are now due.
Oh my gosh. Yeah. It's crazy. It's crazy.
Okay, so another one I've seen people worry about impacting their credit scores by applying for something like that. That's a reason a lot of people say that they don't want to apply for a mortgage because they know they're not quite ready and they don't want to hurt their credit score.
Yes. So yes, a lot of inquiries for new credit lines can impact your credit score. One of the biggest things I see is when somebody is either buying an auto, a new car, right? Or even a refinance of a car.
Yeah.
They shop it around like crazy. So it's going to show up as quite a few inquiries. So typically when somebody buys a car, the credit score is going to drop until you make probably 2 or 3 payments to get that back leveled out. So that's something. So it's like if you are, planning on buying a house, just don't buy a brand new car.
Don't make any purchases at that time.
Refinance, at that time.
Yeah.
Yeah, because that can impact it. But, the inquiries too, we also have to double check to make sure that there's not what we call non-disclosed debt. Like if we have an inquiry on the credit report and it doesn't show up as a credit item on the actual credit report, we have to determine, is it new debt that we don't know about?
Gotcha.
Right. So we're still going to have to verify it.
Yeah. But does it hurt if someone is shopping around? So they talk to a lender and they want to shop around is because of fair lending laws. Isn't it where it only counts as one pull? So
Correct.
they could
within 30 days.
Okay. Within 30 days.
So within 30 days, it allows you to basically, shop for a car, shop for a mortgage, things like that. And it's not going to be, a big impact on your credit. It's only supposed to ding you like one time.
Okay.
Now,
but it's if it's the same category. So don't go buy a house, a new car, some new furniture, a new credit card all at once.
Exactly. Those are all going to count separately. Now, there's also a difference too, is a lot of lenders now are only doing a soft credit pull initially, right? That's not going to have any impact on your credit score.
Okay.
Which is why we're doing it. One of the reasons. When you've got somebody that's going to be doing a hard credit pull, that's when it's going to show up as an inquiry on your credit.
Okay.
right? So I would say a lot of times right now, most lenders have switched to the soft credit pull.
Okay. So that's something people can ask for and make sure that it's a soft one to begin with.
Exactly. Now, when we do have to proceed with the, with you have a house and you're ready to move forward with a loan, we do have to have a hard credit pull. Typically with the soft credit pull, it might be one or two bureaus, not all three.
Okay.
And so for the mortgage, we do have to pull all three.
But if people are in that early stage where they're just trying
Soft
to get
credit pull
some,
only.
yeah, because then they can still get the information because sometimes they need that to know what can we qualify for? What will our payments be?
Right. And then that's something that, you had mentioned earlier, but if you've got somebody that's like, well, I'm not sure I'm ready for this. Well, we can do the soft credit pull and then we can do like a credit improvement plan if needed based on that.
Yes. I meant to ask about that because that, like I talked about at the beginning, people will say, I'm going to work on it. And then,
but they don't know what they're doing.
They don't know what they're doing. So
Right.
then they're paying off the wrong thing or getting behind on something else to put their priorities somewhere that it doesn't matter. And then after the year, it hasn't helped at all. And then they're still back at square one. So
Absolutely.
you or a lender can look at that and help to tell them what should be done with that year.
Absolutely. And it's very, very specific.
Okay.
So when we run those reports, it's going to be like, okay, pay down this account to an exact amount, but
Yes.
it's like, it's not what you would think. Like some people would be like, well, it wanted me to pay this balance down to $42.30, but I paid it down to $40. No, don't do that. Like that's not better necessarily because the scoring model it's going to tell us exactly what we need, assuming nothing else changes, how we can get the score up to a certain, let's say there's a certain marker, right, that we're trying to get to. So there's several things that we look at. One is, what's the time frame? How much time do we have? Is it 30 days? Is it 60 days? Is it 90 days? What is it? Right. And then we're looking at what is the target score and where are the scores currently.
Gotcha.
So we're looking at quite a few things, but we're the professionals. Let us run that for you. And if you're not ready, that's okay, because it's great to go ahead and talk to a lender, get a firm plan and then work towards that.
Or even with like a specific amount because, somebody gets their tax return or gets a bonus this time of year, especially Christmas bonus comes in, tax return, and they're like, I have $6,000 extra in hand. Do I put this towards down payment? Should I pay something off? And which way can I use it? And so you can toggle around with those things and tell them better to do only 10% down and pay this down.
Yes.
Because then the higher credit or the better credit score could get them a lower interest rate.
Because we were talking about that. So, and it impacts your homeowner's insurance. There's so many things that your car insurance, for example, your credit score really does have an impact on what you're paying.
Even like utilities and stuff, because utility companies now you're setting up your electricity, your water. The city will ask you for a deposit if your credit score is low because they're worried that they're not. Everybody's worried about getting paid. So
everybody just wants to get paid. That's right. That's right. And so the higher your credit score, the higher the likelihood you're going to pay. And that's how they do things.
Yeah.
So they incent you with, better interest rates, better car interest rates, and all the things.
Yeah. And there's no judgment either. If you want to have Shelley take a look at things,
absolutely.
We know everyone is struggling. I have a landlord right now. She's like, what? She had no problem in the past finding a minimum credit score and great reports coming back on all of her applicants. And right now they're a little iffy. They're all kind of borderline and showing as a higher risk.
Right.
And I was like, this is the world we're in right now. There are so many people struggling. Everyone's credit card debt is higher than it's ever been.
It is.
So this is
nationwide.
Yes. Yep. Everybody is struggling. So there's no judgment. If you need Shelley to look at things.
Absolutely no judgment. You know what? Stuff happens and everybody gets in a situation from time to time. But that's what I'm here for, right? Is to go through that. You want a professional. You get CPAs, you hire all these other people that are professionals in your life. And it's like, why not use a professional? It's just free. Like, I'm not even charging.
Well, I think that's why I wanted to say that, because I think a lot of people worry about judgment. They're like, oh, I better fix things before I talk to her.
No, let me help you fix it.
Right.
The right way, because I know what's going to help.
Yep.
Right? You can try to guess.
Yeah. Well, and when you have it really lined out, because just saying I'm going to fix my credit score this year, like we did with goal setting, having it very specific, if it's like our goal is to get this credit card to this amount this year, it really gives you something to focus on and an exact number. And you can break it up into each month. This is how much we're going to pay down versus just throwing something out that doesn't have SMART goals.
Absolutely.
Very specific, measurable.
So. Attainable.
Yep. Time. Time
We
frame.
forgot the R.
What's R? Shoot. People are probably like, you dummies.
Well, we did our goals, but yeah, I can't remember now what it is.
Reasonable?
Reasonable?
Maybe.
Oh my gosh, now we're going to have to look that up.
I know. All right.
Well,
Hope this helped.
Yeah,
So
this helped on credit. So
Yes.
yeah, talk to a professional.
yes. And of course, we'll have Shelley's info in the show notes. So if you do want her to take a look at things and do a soft pull and give you some tips so you can get ready to buy, because this year interest rates will come down. I'm just going to say it. It will finally happen.
Oh my gosh,
So you're going to get to buy a house this year.
Believe. It will happen.
Like Santa, we all have to believe.
We have to believe. Just believe. Just believe. Yeah, it's going to happen. It's going to happen. But yeah, because really, I mean, seriously, we know this. Like, the sooner that you can buy a house, I mean, that is a key to wealth.
Yeah.
I mean, homes typically don't decline significantly in value. They typically, historically speaking, are only increasing and obviously greater in some years than others. But that's the biggest way to build wealth is equity in your home.
Well, I was reading something the other day because it has been slow here. The real estate market has been very slow the last couple of years for Texas. Not everywhere. Apparently, some areas like New Jersey apparently is just booming. Sellers market, bidding wars and stuff. So
how is that happening?
I don't know. Well, part of it, I was talking to a friend of ours, Katie, who's in New Jersey, and she said it's people and businesses leaving New York. They can get into New Jersey cheaper, but it's the same thing that's happening here because we have Y'all Street coming, which is all the financial institutions are building things in Dallas, and we are going to have our we should be the next largest Y'all Street instead of Wall Street.
Nice.
So cute. But yeah, with all of those businesses coming and the people coming with them, the experts that I was hearing were expecting that we will have more of a boom in our housing market this year and in the coming years.
Amazing.
So
but
competition.
Right now, it's really, but it is still a great time to buy.
It is.
It's a buyer's market.
It is the strongest buyer's market we have had in the history of our
And what
MLS.
does that mean?
It means you have,
what does that mean?
Supply and demand. There are way less buyers than there are sellers. So there's a lot of inventory and not a lot of activity happening. So it means you can negotiate. So don't let the interest rate scare you because you can negotiate closing costs, rate buy downs. You have power right now. And it is shocking how much power. Oh yeah. You can negotiate in all aspects. I prefer closing costs. You can buy down your interest rate and get a much lower rate.
Yes.
You can get repairs done. 5 years ago, we could not ask for any repairs. The house could be crumbling and you couldn't ask for a repair. Yeah. You had to promise to name your firstborn after the sellers.
Oh my gosh, it was, that seller's market was,
And sellers were not, some sellers were great. Some sellers were not nice. They knew that they had 50 buyers waiting in line, so they could tell you no to everything.
They were paying over asking price.
Yes.
And that doesn't happen right now.
It is not happening right now. And sellers are begging. They are begging for people to even come look at their house. There's an average of like 2 to 3 showings a month, according to our stats that we see. It doesn't include everything, so it's probably slightly higher, but those reports, 2 to 3 showings a month.
So you can get a really much better deal now when it's a buyer's market as opposed to a seller's market.
And not pressured into making a rush decision, because I hated the seller's market when people had to make a decision in 30 seconds and pay over value. So right now you can go home and sleep on it. I have a showing tomorrow, a second showing that they saw it 3 weeks ago, and they're coming back for a second showing so the wife can now see it. I mean,
you couldn't have done that.
No. And so being able to take that time is amazing. So work on your credit, talk to Shelley so you can get in a position to buy before the market turns and while it's still in your favor. So.
Absolutely. Because really the price of the home is what stays, right? That is the permanent part of the transaction. The rate, regardless of what it is, you can always refinance down the road.
Yeah.
So it's not permanent.
Yes.
It's temporary.
It is.
So rates drop even further like we're projecting.
Yes. Well, if you have any questions for us or ideas, something you want to hear us talk about for one of our episodes, send us a message on Facebook or Instagram. You can find us Nestology Podcast.
Well, thank you for joining us, where we help you make the best of your nest.
Bye.
Bye.